Okay, welcome everyone to our latest pension webinar. This month we're looking at defined benefit pensions, so also known as final salary type pensions. And today, we're just going to be delving into these types of pensions in a bit more detail, explain sort of how they work, but also some of the options you really need to consider before you potentially take one of these pensions. As always, just a bit of housekeeping first. Clearly, we're going to be talking about financial information today, but it is only guidance. It's not to be considered advice. Your defined benefit pension schemes are quite complex. So if you do have one and you want to discuss this type of pension further, I just urge you to take professional financial advice. The webinar today should run for about 30 minutes. Please feel free to ask questions as we go along. Just drop them into the Q&A box and we'll try and get through to them at the end. And if we run out of time, then I'll come back to you separately to answer your questions. Really important that you stay till the end because everyone on the webinar today is entitled to a free copy of one of our new e-guides, a pension and retirement options guide, which is a really handy booklet that just goes through the kind of different pension options that you might have and the different retirement options you've got with each type of pension. Just a really quick bit about me, the presenter today. My name's Carl Roberts. I'm a qualified registered practicing financial advisor. I've got a law degree. I'm a chartered financial planner and also a fellow of the Personal Finance Society. So it actually makes me one of the most qualified financial advisors in the country. And interestingly, today we're going to be sharing with you some stats and info that we found as part of our research, because I was part of a task force that looked at defined benefit pensions for some of the largest companies in the UK and what the state of these pensions were in. So I'm going to share some of that data with you today. I've founded and created RTS Financial Planning a few years back now. And we're a financial advice firm, wealth management firm, mainly specialising in helping people with their pensions and retirement planning. So let's get into the crux of today's webinar. So a defined benefit pension, also known as a final salary pension. These have been described as the sort of gold-plated, the best type of pension scheme that you can have. And if you've got one, you're considered to be lucky to have this type of pension scheme. And let's just have a quick look at how these types of pension schemes work, because with a defined benefit final salary pension scheme, you do not have your own pot. There is nothing that you can really control in terms of a defined benefit pension. It's actually a promise from the employer to pay you a pension when you retire. It's an income. So let's just have a quick look at a typical formula on how these things are worked out. So what you get paid at retirement is usually dependent on the earnings that you have at the date you leave the scheme, the number of years you worked for that particular employer, and something called an accrual rate. And just as a quick example, so if this particular person was retiring, their salary was £50,000 per year at the point of their retirement. If they'd worked for a company for 30 years and the accrual rate was 80, then this is the formula that works out what sort of pensions you're due. So in this example, 50,000 times 30 divided by 80 equals £18,750 per annum pension from normal retirement age. And the reason these type of pensions are generally seen as gold-plated, very good pension scheme, is because the guaranteed nature of the income that you're provided with. Once a final salary pension is in payment, you'll likely be protected from inflation. So that means that the pension will rise each year as cost of living increases, and it's guaranteed to be paid out until you die. Now, you will still pay or would have paid a contribution to this type of scheme, but rather than it going into your own pot, it goes into one huge pot for all scheme members. And it's up to the employer and the scheme administrators to manage that pot and use it to pay out all of the pension income to the retirees. So in terms of what are the advantages of a defined benefit pension, as we've said, it's a guaranteed income for life. That guaranteed income is protected from inflation. So you'll see your income in retirement continually rise. There is some income that usually is payable on your death to a spouse. That income usually sort of cuts in half. But again, if you're married or have a civil partner, there will be some guaranteed income that's payable up until they die. And of course, you don't need to worry about the stock market because you don't have your own pot. You've got that guaranteed income that you know what it's going to be at the point you retire. Now, if you've worked in the public sector and joined that pension scheme, that will be a defined benefit final salary pension scheme. It's the type of scheme that's offered for all public sector employees. And it's also in the past been the type of pension scheme offered by some of the long-standing big UK employers. But nowadays, you'll probably find that most private sector employers have closed these types of pension schemes for further benefits. Meaning that pension scheme is now deferred until you take your pension. So if a defined benefit pension scheme gets closed, it doesn't mean you've lost your pension. It just means that what you've built up is sort of frozen and there for you when you come to retire. So why have most private sector defined benefit pension schemes now closed? Well, there's three key reasons as to why employers no longer operate these types of schemes. And the first reason is all around life expectancy. Life expectancy has improved massively since these types of pension schemes were first introduced. Interestingly, we can trace these types of schemes back to the 1800s. And actually, obviously, life expectancy was a lot shorter in those times. But defined benefit pension schemes became really popular in the 1940s and 50s, when it was after the war, and the culture at the time was you get a job and it's a job for life. You dedicate yourself to that employer and that employer will then look after you in retirement. Well, of course, in the 1940s, life expectancy was about 60 years. So when these pensions were due to start paying out, they weren't predicted to pay out for very long. Obviously, nowadays, life expectancy is closer to sort of mid-80s, 85. So that's an extra 25 years longer that these pension schemes now have to pay out. And of course, life expectancy is only likely to improve going forward. The other factor as to why these sort of schemes are now closed is all about the investment performance of the pension scheme itself. So like I said earlier, you don't get your own pot in a defined benefit pension scheme, but there is one huge pot that covers all pension members. And the scheme administrators clearly have to look after the assets in that scheme and invest them. Now, some of you may remember the 1980s and Margaret Thatcher, and like her or loathe her, through deregulation, the encouragement of home ownership, privatisation, she did encourage a boom in the stock market. The UK stock market had its sort of best ever period in the 1980s under her rule. And of course, the scheme administrators for defined benefit pensions got overconfident. They saw the returns they were making with their assets and sort of projected that they'd continue making these types of investment returns forever. So it allowed them to promise more and higher pension income for pensioners. And of course, we all know that since the 80s, we've seen some rather large stock market crashes. So the graph on screen now is the FTSE All Share, which is a measurement of the UK stock market, basically. And I'm sure you'll all remember that back in the sort of early 2000s, there was the dot-com stock market crash. And we've also more recently seen the great financial crisis starting in 2007. So there was a big disconnect to what the expected returns were for some of these defined benefit pension schemes and what the actual returns ended up being, which leads on to sort of the third reason why most schemes are now closed. And it's all around the scheme liability. You see, the employer who created the defined benefit pension scheme has made a promise to pay you an income in retirement, and they're liable to pay that income for as long as you live, regardless of how well their investments have performed in the scheme. So if you live longer than expected and the investments of the scheme haven't performed as well as expected, that can leave the scheme without enough money to cover their promise. And if a DB pension doesn't have enough money to pay all of the pensioners the income they promised, it means the scheme is in deficit and the employer has to plug the gap. And what kind of company wants to have a never-ending liability hanging over them that they can't control, that they have to constantly use the revenue that they've earned to keep plugging the gap in the pension scheme? So ultimately, nowadays, most employers have closed these types of scheme. So if you've got a defined benefit pension, and I imagine you have if you're on this webinar today, obviously you've got some decisions to make when it comes to deciding whether to take this type of scheme. And I just want to put you in a very clear picture and bust some of the myths that are not often talked about with these types of pension schemes. So myth number one is interesting, it might shock you, but actually defined benefit pensions are not guaranteed. They're only guaranteed providing the scheme and the sponsoring employer can afford to pay them. Now, I mentioned earlier that I was part of a task force that delved into, investigated the defined benefit pensions of the FTSE 100, the top UK companies. We found some really fascinating information on these types of schemes. So the FTSE 100, the 100 largest UK companies, most of them with defined benefit schemes or old defined benefit schemes that are no longer open to new members. We found that 59 companies out of 100 had pension schemes in deficit, meaning the liabilities that they are due to pay out to pensioners is more than the assets they have. One was neither in surplus or deficit, and only 28 out of the 100 were in surplus. What was really scary was that we found that 8 companies out of the 100 we looked at had pension liabilities which are more than the company is worth. And 12 have liabilities totaling between 50 and 100% of the company worth, and 17 have liabilities between 25 and 50% of the company worth. So these are huge liabilities for companies to be operating and looking at. And here's 8 of those companies with the highest liabilities when measured as a percentage of company value. So if we look at the top one there, the International Airlines Group, owners of BA, British Airways, they have a pension scheme liabilities that are nearly 3 times higher than the company is worth. And this data was actually put together before COVID struck. So I imagine that is even worse nowadays. And if you look, there's some big names on there. You saw Marks and Spencer's, your Sainsbury's, there's Banks, Barclays, and RBS, all with huge defined benefit pension liabilities. So if your company has quite a high deficit, that company has got to keep feeding that pension scheme to ensure it survives. And if we look at some of these companies, are they in the right sectors? Are they going to be able to continue growing their revenue to ensure that these pension schemes survive? You've got Marks Spencer there, a struggling retailer. We've already said the International Airlines Group, BA, that's not a sector to be in at the moment, is it, with what's going on with travel restrictions? So when looking at your pension scheme, if you've got a pension scheme and it's got a deficit, how likely is it that your company is going to survive in the long term? Interestingly, if we go back to 1999 and we take a snapshot of the FTSE 100 at that point in time, the 100 biggest companies in the UK, if we now look at it today, only 49 of those companies that made up the FTSE 100 in 1999 have survived to today. 51 have actually been removed. Now, they could have been removed because the value is just lower now, so they've slipped out of the FTSE 100 and perhaps into another index. It could mean that they've been taken over or bought out, or it could also have been because they've gone bust. So one thing to be really clear is that your defined benefit pension scheme is never completely guaranteed. It's only guaranteed as long as the company that it's with continues to survive and is able to pay those benefits. And obviously recently in the news, we've seen some big names that have gone bust with big defined benefit pension schemes. Okay, the second myth, I suppose, is more around what happens if the employer sponsoring the pension scheme does go bust. You may have heard of something called the Pension Protection Fund, and that many people believe that it's there to save you. It's a lifeboat scheme that helps protect members of defined benefit pensions. But actually, the Pension Protection Fund does not have to take all failed defined benefit schemes. It's not compulsory that it has to. What usually happens is if your employer goes bust and leaves the defined benefit pension scheme in deficit, the Pension Protection Fund will start to investigate and will look at the scheme and will look at how much it has in assets and whether they feel they can reasonably take it on, because they have certain rules that they have to follow in order to protect all the current members of the Pension Protection Fund. So even if the Pension Protection Fund does decide to take on your defined benefit pension scheme from a failed employer, there are still certain rules that cap the benefits you might ultimately get. So if the Pension Protection Fund does take over, now if you've already passed the scheme retirement age at the point the business goes bust, you should in theory be 100% protected if the Pension Protection Fund takes over. So the benefits you are due, you should in theory get 100% of those. But if the business went insolvent before you reached the normal retirement age, then your pension benefits will be reduced to 90% of what you originally promised, and it will be capped as well. So the higher the defined benefit pension you're entitled to, the more chance of you hitting the cap. The cap's about sort of £40,000 a year, but obviously you only get 90% of that. And more importantly, in a way, is that if you've got defined benefit pension benefits pre-1997, those benefits lose their index linking, so they will not continue to rise with inflation. And actually, even if you've got benefits after that period, the inflation rise is capped at 2.5%. So whilst there's a protection scheme there, if your business does go bust, it's still highly likely that you're not going to get the same benefits as you would have. So we've looked at some of the advantages of defined benefit. Let's just summarise the disadvantages then. If you get a defined benefit pension and you agree to take it, that income you start to receive is sort of fixed in stone. You can't change your mind. So that income, in theory, will continue for the rest of your life. So if your life style changes, some people nowadays take career breaks. They might not necessarily retire straight away. They might want to come back and work. You're not going to be able to switch this income off. It's going to continue paying. We've sort of mentioned death benefits. Again, whilst you might get some form of death benefits or an income paid out to a spouse on your death, if you're not married, that's no use to you. There'll be nothing to pay out to anyone. And obviously, once your spouse is gone, there's nothing for your children. So the death benefits aren't great. And like we've said, actually, these schemes aren't guaranteed. The employer must remain solvent to continue to pay your pension fund. So if you have a deferred private sector defined benefit final salary pension and it doesn't feel like it's the right type of pension for you, what can you do? Well, of course, the alternative is that you have a personal pension, a defined contribution pension where you have a pot that you control and you take your pension in a different way. So before 2014, if you had one of these personal pensions, most people were forced down what's called an annuity route. So when you got to retirement age, you had to take your personal pension and buy an annuity, which effectively tried to turn it into a defined benefit pension. It gave you a guaranteed income for life. But in 2014, the then Chancellor, George Osborne, announced something called pension freedoms. And this meant that everyone basically had full control over their personal pension pot. They could do what they wanted with it. So nowadays, with a personal pension, you've got full flexibility. You think of your pension as a big savings account or a big bucket with a tap on it. You can turn that tap on and off as and when you need to. You can take lump sums out of a personal pension. You can take a regular income. You can stop that income. You can withdraw the whole thing. It's really fully flexible. Now, there's no guarantees with drawing down your money this way, because obviously now you've got control of the pot. It's up to you to kind of invest it appropriately and try not to take out too much too fast, so that the money ends up running out. And remember, if you're in retirement, you could be looking at managing this type of pot for around 30 years. So in order to convert your defined benefit pension to a personal pension, you need to ask for something called a cash equivalent transfer value. And this is where the scheme will basically work out what they think your promised income is worth as a value. Now, there's rules in place that mean that if your guaranteed benefits from a defined benefit pension are over £30,000, then you legally have to get professional advice before you can transfer. And to be clear here, your pension must be deferred, so sort of closed for further accrual, and you must be in the private sector. The public sector does not allow you to transfer defined benefit schemes. The only place you might be able to transfer a public sector scheme is from a local government pension scheme. If it's funded, then there may still be transfer values offered for this type of pension scheme. So if the advice is right and you take your cash equivalent transfer value, you can end up with a defined contribution pension. So you end up with a personal pension and a pot that you can now manage and decide how you want to draw down. And what you've effectively done there is that you've taken the liability away from the employer and you've taken it on yourself. So rather than the employer having to promise and guarantee you an income for life, you've let the employer off the hook, and you've said, actually, you'll make your own way in life. You'll decide what happens. So I just want to put that into perspective and look at a couple of real life examples of clients we've helped and seen dealing with defined benefit pensions. So the first example we've got here is around, a large cash equivalent transfer value and the sort of death benefits available. So this particular client is married, has two daughters who are both off to university. They really wanted to cover their university costs for their children. And they also wanted to have some money to be able to gift to them to help them with their first homes. So the offer for this particular client with their defined benefit pension was that if they retired at 60, they would have a pension of £27,000 per annum. So we looked at and requested a cash equivalent transfer value, and this particular scheme were willing to offer £1 million in order for that client to give up their defined benefit pension. So transfer £1 million into a personal pension. Now, I just want to flip it another way and ask you that if I said to you, here's an investment, a defined benefit pension, here's an investment that you're guaranteed to lose 50% of it on your death. So your spouse will only receive 50% of that investment on your death. And then your spouse is guaranteed to lose 100% on their death, meaning nothing for your children. And this was the sort of lines this particular client was thinking about. Obviously, with the alternative option, by taking the transfer value and look at that as an investment, you've got 100% of the remaining value can be passed on at first death, and then 100% of the remaining value can be passed on at second death. So the death benefits can be significantly greater with a transferred personal pension. And even if you're someone that's sort of cautious and actually likes the sound of having that guaranteed income, when you look at the cash equivalent transfer value at £1 million, you only need to make a 2.7% investment return a year to obviously maintain the same level of income you would have had in a defined benefit pension, but also having all the flexibility of being able to take out lump sums. So just going back to that return level, interestingly, if you just look at something really simple like the FTSE 100, the 100 largest UK companies, they will usually provide dividends, profits every year that they pay out around 2 and 4%. So if you took that £1 million, invested it in the FTSE 100, you'll likely see between a 2 and 4% dividend yield anyway, which would cover the income we just showed. And that's before any capital growth in share price. Another example was a client we had who was really keen on early retirement. So this chap, again, married, 2 children, he'd worked in the same job for 37 years and he just wanted to retire early. He wanted to retire at 55. His wife had a good defined benefit pension scheme in her own right, and their state pensions were likely to cover all of their income in retirement. So this particular client, if he had carried on working or not taken a pension to 65, he would have been due £30,000 per year. But he asked for an early retirement quote and they were willing to provide £15,000 per annum. So quite a significant reduction in income. And obviously this is because the pension scheme's got to pay the client for 10 years more. Or the alternative was a cash equivalent transfer of £865,000. So of course, if they stuck with the defined benefit pension, they haven't got any flexibility there, that their income's fixed forever. And actually, they're going to be their most wealthy, they're going to have their most income at the very later stages of their life, which that's just not what they wanted. At 50, if they want to retire at 55 and really enjoy themselves and start to spend significant amounts of money, and then obviously slow it all down as they get older. But obviously, by taking the cash equivalent transfer value, that gives them that full flexibility. They can use that pot and through pension freedoms withdraw it how they want to. And again, giving up the income, by taking the pot, it only needed to achieve a 1.73% investment return to match the income given up at 55. So all we're trying to do during this webinar is we're not trying to force you down one route or the other. For the majority of people, sticking with their defined benefit pension is going to be absolutely right. But before you make that decision, we just really want to make it clear, give you all the knowledge that you know what you're doing and what you're potentially giving up. So as we kind of get close to wrapping up here, let's just summarize the sort of for and against transferring here. So 5 reasons to consider transferring out of a defined benefit pension. The big one is the flexibility. Modern life is now very different to when these schemes were introduced. People take the career breaks, you wind down work, you might want to take out lump sums, help out children. So if you want that type of flexibility rather than the rigid fixed income you get with defined benefit, then that's a reason to potentially consider it. Again, inheritance, we've touched on the death benefits. That if you're someone that really has, quite keen to help out children and pass on your wealth, then transferring is probably going to be a better option for you. We've also looked at the solvency of the scheme, and the employer, more importantly. What's that like? Have you got concerns about your employer surviving longer term? Because remember, the income is only guaranteed as long as the employer survives. Tax-free cash. So if you want a big lump sum or a bigger lump sum, usually you'll get a bigger lump sum by having your money in a personal pension as opposed to a defined benefit pension. To get a lump sum out of a defined benefit pension, you generally have to give up some of your income to get that, and it's usually not as high as you could get for a personal pension. And your health. So if you've got a shortened life expectancy, obviously you could get far more value out of the transfer value rather than sticking with the defined benefit pension scheme and only receiving income for a few years. But like I say, it's not for everyone. So reasons why you'd probably want to consider remaining a defined benefit pension scheme is if you like the certainty, you prefer just knowing what income you're going to get every year and the fact it will last as long as you do. So if you're someone that's quite low risk, you're not comfortable with managing investments, you're not comfortable looking after your own pot. Inflation, obviously there's inflation protection there by staying in a defined benefit pension. So your pension income will continue to rise with the cost of living. And although we've sort of said with the death benefits are potentially not as good with a defined benefit pension, there is still that certainty for spouses. So if you are sort of married in a civil partnership, your partner might prefer, even though their income's reduced by 50%, they might still prefer having the certainty of a 50% income rather than having to manage a pot. And taxation is something to think about. there's such a thing called the lifetime allowance, the pension lifetime allowance, which is around £1 million, and it's the total amount you can hold in pensions without suffering further taxation. And by transferring, sometimes it can mean that the value you get from the transfer is higher, counted towards higher for the person lifetime allowance, sorry, than if you kept the defined benefit pension scheme, because the income uses a formula, and when working out the value against lifetime allowance, so you might sort of fall into that trap if it's a particular high transfer value. So yeah, like I say, we're not trying to say everyone should be coming out of their defined benefit pension. We're just trying to make you aware of all the risks and all the options you need to consider. So this is a typical people that should really at least consider a review of your defined benefit pension. And it's someone that's, if you're married with children, because of the extra death benefits that are potentially available from a transfer, then that could be appropriate. You've got to have some appetite for risk, because if you do decide to transfer, you are taking on the risk, you're taking on the pot. You've got to be comfortable with the investment strategy. A really good feature is if you've got a couple of defined benefit pensions, so maybe one or two of the others with your state pension would already cover all your essential retirement spending. So actually, you could use one defined benefit pension to give you that little bit more flexibility. The cash equivalent transfer value is important. You want to be offered a good deal by your defined benefit pension company, because we've seen some really low transfer values offered and we've seen some really high transfer values offered. So that would be a factor to consider. We've touched on, pensions aren't necessarily guaranteed. So if it concerns you and your scheme has a high deficit and it's an employer that's in a sector of the economy that's not likely to grow in the future, then that would be a warning sign and something to review. Ideally, you must have left the company and the scheme must be closed to be able to look at transfer. And if it's still an active defined benefits pension scheme, it's highly unlikely you'll be able to sort of move out of that, or it wouldn't be recommended. And ultimately, you want the income flexibility, you want the higher death benefits or a higher tax-free lump sum. All of this sort of stuff you're not going to be able to get with a defined benefit pension, but you could if you transferred. So, like I say, if you sort of tick a number of those boxes, it's probably at least worth considering getting a review of your options. And the time, if you want to transfer, it sounds like a transfer is right for you, and the advice is that that's the case. The time to do it is now, because transfer values are calculated based on interest rates. So typically, the higher the interest rates, the lower the transfer value you'll be offered. But what's happened to interest rates at the moment? They're at rock bottom lows. So the lower the interest rates, the higher the capital value that you'll be offered. So if you're going to look at doing it and reviewing your options, now is the time to definitely do it. Okay, so I hope that content was useful, sort of whizzed through it a bit there. I mentioned at the start, obviously, everyone's entitled to our new free e-guide on pension retirement options. So basically, we'll be emailing that out to you later with a recording of this webinar, so you've got all the information to hand there. So we've now just got time for a few questions. So I'm just going to check the question box here. So just bear with me a second. So if you've got any other questions, then just please feel free to type one out now. We've just got a couple of questions about the recording and the slides and things. So like I said, later on, you'll get an email with the recording of the webinar. And someone's put here, what level of scheme deficit should cause concern? Okay, that's a really interesting one, and a really good question. So there's sort of two parts to it, really. If your defined benefit pension scheme is in deficit, you've got to look at two things. One, how big is the deficit? Because every defined benefit pension scheme is instructed by the regulator to have a funding plan in place. So if they've got a deficit, they need to have worked with the regulator to say, right, we aim to plug that gap within a number of years. And then the second bit you've got to look at is what's happening with the employer. How likely is that employer to survive long term? Are they going to be able to grow sales? Are they in a big market where they're going to be able to capture more market share? Because if the employer's suffering, if they're likely, no disrespect to sort of Marks and Spencers, but if it's a struggling high street retailer, are they likely to be able to continue increasing sales and then plug their deficit? Not sure. So that's the kind of key thing, really. I mean, if we're looking at numbers, roughly, you'd sort of say anything. If the scheme's only funded 80% or less, then it's quite a big warning sign. Another question we've got here is, what's a good size transfer value? And I think when you say good size transfer, I think you're referring there to a multiple of the pension income. So just to give you a few examples, we've seen some multiples where the cash equivalent transfer value offered is around sort of 25 times the income, which is, that's probably a baseline. We've actually seen some transfer values where the multiple is 50 times, and that tends to be sort of some of the big banks. They might pay very good transfer values, but you're probably looking, anything around sort of towards 30 or more would be considered a pretty good transfer value. Another question here is, would you invest in FTSE 100 or other indexes, and if so, which ones? Probably a bit of a different question in terms of whether that's related to defined benefit pensions or not. But in terms of investment strategy, I mean, we could do a whole nother webinar on this, but I wouldn't recommend you just solely look at the FTSE 100. You'd be wanting to take a much more kind of global approach to your investments. And obviously, it will very much depend on your attitude to investment risk and what you need to achieve. So if you need a return that's higher, you're going to be looking at more stock market equity approach. But if you're quite low risk and you don't need as much return, then you're going to be wanting to add things like fixed interest into your portfolio, so it reduces the risk. Okay, so that's all answered the questions so far. Just to wrap up, we have our next webinars coming up next month in April. And this time we're going to just move away from pensions. I'm going to be looking at inheritance tax. So what's been going on with inheritance tax and some planning you can do to ensure that your family don't end up paying inheritance tax. So with the email that comes out later today, there'll be a registration link for you to register for the next webinar if that looks good to you. So that's it from me today. Thank you very much for your time. I hope you found that useful. If you do think of any questions afterwards, you've got my contact details on screen there. You do feel free to just ping me an email. Happily, answer any questions you've got, or have a quick chat on the phone, whatever you prefer. But that's it for today. So again, thank you for your time, and take care.